Good afternoon, everyone, and welcome to the first CVCA webinar of the Invest Canada series. We're going to give people a chance to sign in. This webinar is Sourcing Relationship Management Complexity and the New Normal for Dealmakers. Your panelists will be joining you shortly, so I will just give everyone a few minutes and then I'll kick things off and pass the floor on to our panelists. Thank you for joining us. We were really excited as we were planning Invest and talking to a number of our sponsors about going virtual and really moving in a new direction given the circumstances that we face with COVID. We had this idea that perhaps Invest could last more than a few days as it does when it's an in-person conference. So what we chose to do is to have the virtual conference, but then continue the conversation with our members, our sponsors, and key people in our industry around some topics. So I was saying to the staff, we have a very ambitious agenda of webinars coming your way for the fall. Over the next 4 months, every 2 weeks, you will have a webinar, different topics, different people bringing to you insights to help you think about your business and how to manage your business. We will be circulating eventually a list when it's a little bit more fulsome of the dates and the topics, and then you can mark your calendar and plan to attend the one that you are interested in, because you may not be interested in all of them. So, and I was saying to the staff, like, we don't want to start spamming people, but there will be a lot of content and a lot of things coming your way in the fall. And I just wanted to give you a heads up of the amount that will be coming to you. And we hope to get feedback from you as to how we're doing and if there are topics that we haven't covered. I always like to think that September is really the new year, as September 1st sometimes feels more of a reset than January 1st. And for us at CVCA, we've had a very busy, as all of you have had, a spring with Invest, and then this summer we were teeing up a lot of the things that we'll be doing for you in the fall. And I just wanted to flag two things. We have two really big initiatives, one for venture capital and one for private equity. On the venture capital side, we're having some very intense conversation with the government about agreeing to do a third program that would follow VCAP and Vicky. And we're in the midst of these conversations, working very hard, and the fall will be hopefully spent talking about the details of what a third program would look like. And on private equity, if you spent any time with me in the last year, you would know that private equity is top of my list, and talking to decision maker and stakeholders about the value that private equity brings to Canada's economy, what it does for communities, for entrepreneurs, for businesses, and growing them and creating productivity and efficiencies in our economy. And we will be pivoting this PE campaign that we had planned to do in person across the country to virtual roundtables, and we will be doing success stories and really amplifying the message across the country with provincial policymakers and decision makers as to why it's important. So follow us, keep in touch. You'll be receiving things from us, and we're well rested. The staff has taken some time this summer, and we're going to be ready to start working really hard for end of Q3, Q4 to deliver for all of you. So without further ado, I will pass the floor to Amit, who will do all of the housekeeping notes and introduce you to your panelists. Enjoy the webinar, and thank you for being here.
Thank you, Kim. Hello, everybody, and welcome to our webinar. As Kim said, my name is Amit Lalwani, and I focus on the global business development efforts here at DealCloud. Today, I'm excited to be joined by Aziz Musalier, Managing Director and Head of Financial Sponsors at National Bank, and Sean McKinnon, Head of Business Development at Novacap. And they will share their perspectives today, both from the buy side and the sell side, placing focus on how relationship management tactics have changed over the past 6 months in this new normal that we are all living together. Before we begin, I just want to make sure that we take a couple of moments to review some basic housekeeping items. We, the DealCloud team, the CVCA team, our panelists are all working from home, and there may be an occasional background noise, so I hope you can excuse us if that happens. As Zoom experiences some high usage volume, we may experience connectivity issues or slowness. While it's unlikely, it's worth mentioning that if we do have any issues, this session is being recorded, and we will send all of you, after this webinar is finished, a link to the recording. Lastly, we want to try and keep this webinar interactive, so participants can submit their questions during the webinar via the Q&A function that's available to you. We will answer as many questions as we possibly can towards the tail end of the presentation. With that said, let's get started. What I want to do before we jump into the actual questions is just do a quick intro of all three of us. I'll take a quick minute to introduce myself and then pass it on to Sean and Aziz. So as mentioned, I head up our global business development efforts at DealCloud. DealCloud is a purpose-built relationship deal management platform. We've been around for about 10 years. Very excited to say we've got almost 900 clients across the private equity and investment banking space. And we have about 40,000 users globally. Very, very excited about our partnership with CVCA, and also excited to hear from our panelists today. I'll hand it over to Sean to quickly introduce himself.
Hi everyone, Sean McKinnon. I'm with Novacap, and for those of you who don't know Novacap, we're one of the oldest, if not the oldest, private equity firm in Canada. I've been investing in private equity for almost 40 years now. We have just under $4 billion of committed capital, and we invest across 3 different fund strategies: the tech, media, and telecom, diversified industries, and our financial services strategy. So my role at the firm is to really lead the business development function with my team, and we're responsible for all origination and sourcing activities across all 3 different fund strategies.
Thank you, Sean. Aziz, let's hear from you.
Hello all. For those that don't know me, Aziz Msalier. I've been at National Bank for about 4 years, where I lead our sponsor coverage efforts. So basically my role is to help facilitate all potential connections between Canadian companies and investors, whether in Canada, US, or internationally. As most of you guys know, National Bank is one of the big 6 banks in Canada. We are the fastest growing one, and just to use this as marketing, we are on the top of the M&A league tables as of at least this morning. So pleasure to be on the line.
Awesome. Thanks a lot, Aziz, and I hope you can stay there for as long as possible. So now that the introductions are done, hopefully the folks that have joined in have a little more background on our panelists. We're going to dive right into some of the key topics for today. So we'll start with Sean. And Sean, I'd love to hear from you. How does Novacap continue to interact with intermediaries for sourcing? And over the past 6 months, we all know the world has changed. A lot of things are different now. So we'd love to hear from you how that past 6 months have brought about some changes in the way you interact with your intermediaries for deal sourcing.
Absolutely. So I guess just to provide some context on kind of where Novacap has come from. So given the long history of Novacap in Canada and in North America and investing in private equity, you know, we've had a real good historical success in developing direct relationships with entrepreneurs, and that's led to about over 80% of our total transactions over the 40-year period, you know, arising out of direct relationships with entrepreneurs and partnering directly with entrepreneurs. So that's kind of where we've come from. You know, as we've grown as a firm, the reliance on intermediaries has increased quite significantly, and this has become a big focal point of Novacap moving forward. And as a result of the deal size and generally the sophistication of the sellers, you know, there's always going to be an intermediary involved, someone like Aziz's team who will be leading the charge on the sales side process. And I'd say that's more and more frequent. You know, given the way that COVID has kind of changed the landscape, you know, we've taken, you know, a big, I guess, a bigger step in towards developing those relationships more deeply with our intermediary partners across North America to make sure that we have, you know, the understanding of what we're looking for in terms of potential acquisitions across all 3 of our fund strategies, you know, developing the relationships on a personal side between the sector-specific intermediaries and bankers who focus on really on niche you know, products and companies, and making sure that we're top of mind for those types of opportunities. I guess the fact that there's, you know, everybody knows it, there's a lot more dry powder out there. I think the deal flow basically, you know, really came to an abrupt halt at the very beginning of COVID. So there's a lot of eager buyers out there for, you know, not as many opportunities. So we really feel like, our relationships with intermediaries has become so much more of a focal point, more of an importance for us to be included in these, what we call moderate or limited processes, as they look, the intermediaries look for more certainty around close. So I would say the focal point for us is, we've really honed in and increased our coverage on the intermediaries as well.
Awesome. I'm sure there's music to the intermediaries, yours, and also the ones that you have solid relationships with, and the intermediaries that have invested time over the past few years will benefit from this. Sean, another question for you with regards to the percentage of deals that you source. How much of it do you think is coming from intermediaries compared to proprietary? And maybe if you could contrast it with pre-COVID and current time.
Sure. So I think, from our perspective, we spend a lot of time with entrepreneurs. Historically, we have been the first institutional capital for entrepreneurs as they're selling their business. So that's always been a big priority for us. So we're continuing to do that on a regular basis and continue doing outreach across the board from all angles, whether you can Zoom or whether it's just phone calls, emails, however we do it, we still put a huge emphasis on that. But we realize that the deals are being intermediated more and more these days, and they're the more actionable deals that are coming out. So typically, the process, and everybody probably on the line would know this, that you can have a conversation with an entrepreneur, it might take 5, 10 years, maybe 1 year, depending on their readiness to complete a transaction. Whereas when the deals are coming in through an intermediary, they're very actionable, and that's something that you can focus on immediately. So I'd say since COVID has happened, the bulk of what we're seeing is very much intermediated. So a lot of investment bank-led processes that are coming out. What we've noticed is there's a lot more selective about who they're inviting to the processes, because they want to make sure that they see a certainty of close. So that's kind of where we're focusing our time, is to really get ahead of those and making sure that we're including those processes. And that also includes spending a lot of time with the company before they even come to market. So it's about doing the legwork up front, whether or not it leads to what we call, I guess, proprietary is a word that's thrown out there quite a bit, but it's more like privileged or advantage deals, I would say. But putting that time and effort with those entrepreneurs ahead of time, so that we're ready when they come to market, is a core part of our sourcing strategy.
That makes so much sense. And Sean, I would be remiss if I didn't ask you being a DealCloud client for more than a year, so we appreciate your business. How are you using DealCloud for your relationship management, sourcing, and origination?
So because Novacap's grown, we've had, again, 3 distinct fund strategies. We're growing in terms of our total team members across the board. We really needed a robust CRM to handle all the input from the various sources across the firm. So when we did a review of all the options out there, DealCloud really stood out as the one that was the best fit for Novacap as a firm, and particularly it seemed like the one that most of the people in the industry were switching to. So we've really looked to leverage and refine the platform as much as possible, so that it makes sense for what we're trying to achieve, and trying to get internal buy-in to understand that this is a tool that can really enhance our business development and relationship management activities. And so it's been a huge success for us internally, and we're continuing to leverage it as much as possible and benefit from all the updates and all the the new features that DealCloud keeps on putting out.
Thank you very much, Sean. Let's pivot a little to Aziz and hear a little bit from the sell side's perspective. Aziz, would you mind just sharing a little bit about your firm's approach towards sponsor coverage and how that has changed over the past 6 months?
Perfect. So first, on our coverage model, sponsor coverage for National Bank is highly centralized, and it's really contained within the team that I lead, with some sector bankers or industry bankers supplementing that coverage with a few very important relationships with some investment professionals. Given we're Canadian focused as an institution with some exceptions, investment bank, just to be clear, we view our role to deliver basically Canada to the world, and that's one of 3 things. One is helping Canadian entrepreneurs and companies raise capital or sell their businesses to sponsors like Sean. and effectively finding a mix of fit, both in terms of strategy and personal chemistry, because that matters a lot. The second is helping companies, Canadian companies, acquire portfolio companies of sponsors regardless of their location. So we really use our coverage effort as a buy-side engine. And then lastly, whenever someone like Sean or Novacap owns a business, we help them on the financing, M&A, exit strategies. Now, our coverage model, because of what I described earlier, has to be broad. So we cover 600-700 institutions, Canadian, US, international, all stages, because we need to be able to place the right type of capital to the right situation. As Sean said earlier, there's a lot of capital out there. So it's really, the fit matters a lot in this market. Second is we try to be very systematic and proactive in our approach. We're very frequently trying to initiate processes, one-off discussions, as Sean said earlier, understanding really what gets them ticking is key for us so that we can give them these more proprietary situations. Thirdly and lastly, everything is centralized, as you've heard earlier, within within Canada, within that team, so that effectively we do not have a dependency on someone sitting in the US or Europe to have access to these folks. So we eliminate the broken phone. So now the impact of COVID, interestingly, hasn't had a major change to the way we run our business. We've had to do a few tweaks in the first 2 months. As you can imagine, we were very close to our clients, focusing really at understanding their financing needs and actually pitching what we used to call our contingency planning efforts. So effectively restructuring. And obviously that we had a big boom earlier this year on that. We then pivoted into focusing probably a bit more of our attention earlier this year with special sits. Investors, given what was in the market, as you can imagine, and even understanding with folks like Novacap how they've transitioned their franchise in some cases towards that situation in those tougher times. And I'd say finally, as Sean alluded to, I think now that we're coming a bit out of it and we're kickstarting the M&A processes, I'd say in many cases the processes are a bit more targeted than we may have had historically. I'd say the last probably impact of all of COVID on us is obviously travel time has been decreased, which is a good thing because it gives us more time to spend with our clients. But the negative of that is a lot of that human interaction that is key to set up relationships is obviously not as powerful. And it's a bit more difficult to be systematic in our coverage approach. So what we're doing starting in September and October is creating effectively virtual tours where we're go to Boston, meet 15 of our clients there over a course of 3 days, and effectively replicates our, say, Boston business trips that we used to have a couple of times a year.
Awesome. Sean, Aziz, you just bled into the next natural question that I was going to ask you about your marketing efforts. And I've heard a lot about how virtual tours are being leveraged. How are you differentiating between for this specific asset, this should have a very targeted approach compared to a full-blown marketing approach? And when do you find virtual tours actually do help, and when are they not all that efficient?
So I think the virtual tours for us, as far as the coverage model is concerned, is just ensures that we maintain in touch with our clients and understand how their strategies have evolved through the years. Because what we've noticed is there's been a lot of evolution over the last 6 months with COVID. As far as process design, it really is depending on the asset. I'd say some situations just naturally lend themselves to having a handful or 2 handful of conversations, just given transaction complexity, what the entrepreneur is looking for, potentially even the border issues or the border being closed, and some we go broader. So we've had a bit of both. With COVID. Okay,
great. And the last thing I have for you on this piece, Aziz, is you recently became a DealCloud client. So we appreciate you picking us. I know it was a long, very diligent process that you ran. If you don't mind sharing with us, how do you intend to use DealCloud? I know we've touched on buyer's list. We've touched on single source of truth. We'd just love to hear from the head of financial sponsors at a bank. what do you expect and what are you excited about using DealCloud for?
Yeah, so as you know, Amit, we've just kickstarted the implementation processes of probably about a week and a half, not a week and a half, a month and a half ago, and had multiple, discovery sessions with all the industry and product teams. I would say so far there's been a meaningful amount of buy-in. I think what COVID and being forced to work from home made us all realize is how critical it was for us to have that single source of truth and some technology to help us manage our firm, our deal flow, and our contacts with our clients. To answer your second question, how we intend to use it, first, obviously the CRM as a contact management tool, and obviously, key there for you guys as a selling point was the Outlook integration that, facilitates all of that. Second, most importantly for us was to effectively help us manage and centralize the management of all of our opportunities and pipelines. We all have separate lists to the organization, and it's very difficult for all of us to have a picture of what's happening in the world. Obviously, naturally, we do have daily communications, but we intend to use DealCloud for that. The third is that we're considered looking at is using some of your process management functionalities to automate and manage some of our key processes. So say, KYC, client onboarding, compliance, just effectively to remove a pain point from the organization. Fourth, on the M&A front, we intend to use obviously DealCloud for both buyer list generation and buyer log management so that we can better harness the wealth of this data that we all have within the organization. And lastly, for sponsors, as you can imagine, as you've heard earlier, we have a lot of relationships. We have a lot of intelligence and a lot of data on basically every single Canadian PE-backed business, a lot of targets, portfolio companies sitting in the US funds that we need to maintain this data in a central way so that we can maximize its use for our clients. So obviously that's going to be key for us, and it's going to facilitate a lot of, or put oil to all these interactions for us.
Awesome. Well, we're here to support you and provide the ROI that you expect. So thank you. I want to move on to the next stage of this discussion, and this will be questions that are open both for Aziz and Sean. Aziz, since we're with you, let's maybe pose this to you first, and then Sean, feel free to jump in to provide your comments. How has the relationship dynamic changed with the business owners that you interact with?
Yeah, interesting and surprisingly for us, it hasn't changed in a meaningful way despite the physical distancing. Again, I'm here being specific with clients that we knew already. Obviously, we all miss the ability to break bread with these entrepreneurs, and obviously in some cases it helps. And we have started on one-off basis to have these type of more physically non-distant or whatever face-to-face conversations with our clients. I'd say that the crisis for a lot of entrepreneurs, especially with the banks, helped them identify who's really going to be there for them, whether on the lending side, whether they're to help them assist think through their alternatives and who isn't. And we do hope that during these last 6 months, we've demonstrated to our clients that National Bank is there to help, and that we're going to be supported. So I'd say, if anything, it kind of strengthened the relationships that already existed. Obviously, for prospecting, it's a bit more complicated to meet a new client without that physical connection.
Got it. Sean, how do you think about your relationship and the dynamics with the business owners?
The business owners, it's funny, during COVID, I think I'm getting a lot more callbacks than I historically had. So it seems like business owners are more willing to talk, which is great. And I think, as a result of it, we're having a lot of meaningful conversations. And ultimately, we're becoming a bit more efficient with it. So, given that, you can't necessarily meet with people in person, and it has to be a Zoom or a phone call or however it is, you can kind of cut to the chase a bit quicker on certain things and find out what the needs and kind of are the entrepreneurs and business owners, and then act accordingly. So I would say that in terms of our direct outreach to companies, we've had a big uptick during COVID. People are answering their phones, people are getting back to you, we're having more meaningful meetings, we're signing more NDAs, And it's just, it's been a positive change for us as a result of, again, a more efficient, less travel intense type of process. That being said, it is a relationship building, business, and so we need to, to do that, in person, and to really have those conversations in person. It's hard to really replicate that through a Zoom meeting, but it's doing a decent job for now.
Right. You make the most of what you have at the given time, I guess.
Yeah, absolutely.
Sean, I'll stick with you, and the next question I have here is, how important is it for a fund to specifically communicate your strike zone when you're working with somebody like Aziz?
So I guess, given to what we were speaking about earlier in terms of the amount of private equity firms and money, not necessarily family offices, everybody who's looking for deals, I think, we have to really differentiate yourselves from the rest of the pack. And part of that is really, having a clear communication of what you're looking for, and a clearly defined strategy of the types of businesses that you're looking at, and communicating it to the intermediaries so that they know and that you're kept top of mind. I think that is extremely important. If you don't register your interest on either a specific company or a specific subsector, ultimately you're just going to be left out of the process moving forward, because they're a bit more, they're becoming more and more narrower. So for us, it's a huge part of what we're spending a lot of time on these days, really reaching out, making sure that the intermediaries out there understand what we're looking for, why we're a good fit for these types of opportunities, and really doing it frequently so that we're making sure that we're top of mind for these opportunities. Because otherwise, I feel like we're just going to be left out.
Got it. Aziz, from your perspective, I'm sure it's the other view of it, where you want to know who to talk to. How do you go about getting all of that fund preference into your radar, and how do you work with that?
Yeah, so as Sean said, I'll cover maybe the first thing. It's extremely important, I've said it earlier, for us to actually understand what gets a fund or a sponsor interested, because in many cases we have to be very targeted. And besides that, we actually use a lot of these relationships to actually help us win mandates, to be frank. So all this information is that we gather when speaking to people like Sean is documented, at least within the firm, within call reports, and set up in the database that is going to be uploaded through DealCloud, so that we can facilitate a bit of that slicing and dicing. And for us, the key is twofold. When we have a limited number of calls, we want to know who are the 5 first calls we want to make for that particular situation, where both sector, size, and chemistry is going to work extremely well with the entrepreneur or the company. Second, and some of our clients know this, when we're actually pitching on transactions, we actually will call the handful of sponsors that we know are very focused on these sectors that can actually help us win the mandate. So it's kind of a win-win situation, where if they help us feed us and help us win, obviously they're naturally going to be involved in the process, or have an inside track, not an inside track, but have a kind of not an advantage, but ensure that they're part of it. So it's very important. And as far as we're concerned, there is a movement towards more and more specialization in the private equity world. It is key to be able to be competitive in these very competitive processes. So understanding really what gets a fund ticking is key.
Got it. Aziz, just sticking with you, I know that when teams are in the same city, probably in the same country, it's still relatively easier to somehow get together. And in today's time, that's become tough, but it's even tougher with all the restrictions on the border crossing. Talk about US and Canada. How are you thinking about the cross-border deals in situations like this?
Yeah, that's a very good question. It's something that, frankly, I don't want to say keeps us at night every night, but it's a challenge in this environment to deal with these limitations. So, first off, while we're primarily focused on helping Canadian businesses, most of our transactions have had some form of cross-border element to them, including in this COVID era. So, as an example, we were able to restructure Cirque du Soleil. We were able to get some funding into Bombardier from some institutions in the US. And that was all, we've all been able to accomplish this despite COVID and despite the limitations provided by, these government, border, closures. Now, I would say on the M&A side, what the implication of all of this has been is we've been a bit more selective into what we launch as far as M&A is concerned or private placements is concerned. One, we've been focused at businesses that are a bit more asset light rather than an asset heavy model. And what I mean by that is businesses that do not require as much physical diligence of the facility, which obviously by default would preclude some US funds or international funds to get to the finish line. The second is we've been taking a look at businesses and how they performed during COVID and how they're expected to perform going forward, obviously with a strong preference towards businesses that have less COVID-related uncertainty, or in some cases have actually demonstrated the resilience to COVID and their ability to not only weather the storm or succeed out of it better than expected. I think the third element is, and this is partly key for the two transactions I talked about, is if it's a transaction that has a structured component to it, obviously it's a bit easier to get to the finish line without some physical diligence. So we have kickstarting these processes a bit earlier on despite the limitations. And finally, I'd say the last aspect of it is whether we have a seller that wants or needs to sell today, putting aside all these constraints that we're living with. I don't know if Amit, that answers your question.
Yeah, absolutely. That's helpful. Sean, would love to hear your thoughts on the approach towards cross-border deals and how you're positioning yourself to be successful there.
So we look at a lot of cross-border deals. I think it's part of our investment strategy is across North America. So the U.S. is a very large market, so a lot of opportunities, a lot of deal flow there. So we're spending a lot of time on those types of opportunities. Actually, we closed a deal in COVID. It was an add-on for one of our existing portfolio companies. The company was based in Oregon, so quite far away from Montreal and Toronto. And that ended up working out in the end. It was definitely something that was not without its issues and challenges, but a lot of Zoom or FaceTime communication going on with our advisors in the United States. But that being said, we do have a few of our few colleagues who are headquartered in the U.S., so they can I guess take the opportunity and time to spend to have the meetings, management presentations, and so forth in person, where the rest of us could be virtual, which again has helped. It's not as ideal as it would be. It's a bit more challenging, and I would say it does give us a bit of a disadvantage when we're looking at American businesses. But I think in the end, it's part of the new reality. We can't really travel in the U.S., so it doesn't mean we're going to stop looking at opportunities. We're just going to keep on plugging through, and ultimately, I think people in the U.S. are realizing that this is just the new reality too. Because I think even within the United States, there's a reluctance to travel interstate because between states, because certain states are doing a better job than others. So I think it's a challenge. We're doing a lot more of Zoom kind of type meetings, and hopefully that'll change in the near future. Hopefully things will calm down again, but I don't foresee it having any other effect than it already has right now.
Got it. Sean,
I guess actually one more thing I would add, sorry to cut you off there, is that on the flip side, being a Canadian private equity firm headquartered in Canada, it does give us a huge advantage over our American counterparts who are looking at deals in Canada. So, within that respect, I think we have a slight leg up on the USP firms looking at Canadian deals, but I guess the flip side is also true when we're looking at US deals.
Right. Yeah, what I was going to say is we've got a couple more questions for Sean and Aziz, and then we'll open it up for Q&A. Just wanted to make an announcement. There's a Q&A option for folks that are listening in, so feel free to use that. I see a couple of questions coming in. We'll try our best to answer those. Sean, just sticking with you on the topic of relationship management, we've heard about, institutionalizing your knowledge and proprietary data. And on the topic of data, how are you leveraging data, be it proprietary or third party? If you could maybe shed some light on how has that thing changed for you, specifically with regards to building relationship using data?
So it's a good question. And I think as much as this is very much a relationship driven business, you know, the data aspect of it has become kind of a very important part of the whole process, particularly from the sourcing and origination standpoint. So we do, you know, particularly with DealCloud and gathering a lot of intel and data in our CRM is extremely important for us to have that consistency, so we can leverage that information to make smarter decisions around the types of sourcing strategies that we're using. But we haven't subscribed to some external sources, and which funny enough, they do integrate with DealCloud, which is a nice side benefit. So one of them being set in place strategies. So a lot of the investment banking community out there would probably know that well. It allows us to track really all the deal flow of announced deals that have closed in the past number of years, and who are the intermediaries who've acted on them, and whether or not we've been able to see that transaction. So it allows us to hold the investment banking partners that we deal with a bit more accountable in terms of the deal flow that we're getting to see versus the deal flow that's actually getting closed. So we've been leveraging that data a lot just to make sure that we're making the smartest decisions about who we're covering on the investment banking side, and who fits kind of our deal size category, and who's doing the most deals in that space, and really focusing our efforts in a more refined and efficient way to make sure that we're covering off the right intermediaries.
That's great. And Aziz, would love to hear your thoughts. I know you're in the middle of implementation, but how do you think about data when you think about building and leveraging existing relationships?
Yeah, look, as I said earlier, data is key for us. At the end of the day, we really are acting as intermediaries between a company and an investor, or a company and a target. We have a wealth of it. It's all being managed in Excel. And we need to transition towards something that's a bit more centralized, which is what drove that decision with DealCloud. And obviously, as Sean said, some integration with third-party software is going to be big for that. But I made what I'd say is, because I just realized I didn't address it earlier, and I'll pivot it a bit about talking about the use of technology in the deal-making environment. I think DealCloud is going to be key for us to manage our firm going forward and to help harness that. But I think we've had a few interesting and key learnings from COVID that we're going to carry forward in our deal-making effort. And I think we've all realized now that Zoom and Teams, virtual meetings do actually work reasonably well. So I think, in my view, long day are the gone. It's going to be long gone the days where we're going to go travel to a city for a 1-hour meeting and do a quick in and out. I think in some cases that will still happen, but I think it's going to be reduced. Most importantly, it actually also forced us to rethink the way we do deal making. So we've moved towards virtual management meetings. We're recording them in advance. We're giving them in advance to investors, so that or potential buyers, so they actually have access effectively to management earlier on in processes. And I think that's going to be likely there to stay, because there's a net positive from doing that than waiting up until the second phase of the process to give access to management. It's obviously also more time efficient for the management team who actually has to run the business. I'd say the second thing that we've changed a bit is we've started recording a lot more virtual site visits, and using drones and things like that to actually give a bit of physical touch and feel to a facility, which historically we wouldn't as frequently, just simply because it was a lot easier to cross the border. So I think whether the Zoom/Team meetings, whether the pre-recorded management presentations, whether it's virtual site visits. And obviously for us, DealCloud, it's all there to stay, and it's all going to make the firm a lot more efficient going forward in terms of our ability to run a process and manage our institution.
Awesome. That's great to hear. Aziz, you inadvertently answered my next question that I was going to ask about things post-COVID. So maybe I'll just go to Sean for some last comments on that same exact point. Technology is being leveraged to a very high degree now during the COVID times, and people are realizing that, hey, we actually can get a lot done with technology and not getting on a plane. What do you think is going to be the role of technology even post-COVID when we don't have any of these restrictions, and how do you see that being leveraged?
Yeah, so I guess the lack of travel is definitely a good thing. I'm going to be losing my 100K status in no short order, because I don't think there's going to be as much need to travel, and I think it's made the process a lot more efficient in terms of some of the stuff that you would normally do, which required you to be in person. So I think from that respect, I don't think that's going to change too much. I think that's a lasting legacy of COVID is going to be all this virtual Zoom or team meeting. But I do think it's still very much, and I said this probably 3 or 4 times already, it's still very much a relationship game. So at some point or another, we're going to have to really continue to find ways to be creative. We can't cross the border for a reason to build those relationships in a meaningful way, and try and hopefully meet in person with the entrepreneurs or our partners, the investment banks or otherwise, to make sure that we continue to have that dialogue on a regular basis, form those long-lasting relationships that can lead to ultimately closing deals or selling deals or partnering up for other reasons. Yeah,
you're absolutely right, Sean. It actually echoes the sentiment. We had run a dealmaker pulse survey a couple of months ago. DealCloud did that for about 100 firms. And the thought process, the sentiment is exactly the same. Technology is here to stay. We will leverage it and have another arrow in our quiver. But for certain times, certain meetings, certain deals, if we need to get on a plane, so be it. That'll happen. So with that, we're at the end of our questions that we had specifically for Sean and Aziz. I do have a couple of questions that have come in from the audience, and I'd love to just read out a couple of them. We have 3 or 4 minutes left. Hopefully, Sean, Aziz, you guys can provide your feedback on this. So the first one is a question for both Aziz and Sean. Interested to hear your perspective from the opposite sides of the deal-making table. So Sean mentioned certainty of close as an increasingly important attribute that sellers and intermediaries representing sellers are looking for in prospective buyers. With credit markets tightening because of COVID, have deal financing structures changed, with sellers seeking less reliance on bank debt and a larger piece of equity financing, thus creating more certainty of close? Sean, I'll maybe have you speak to this first, and then we can go to Aziz for his comments.
Sure. So I think given where the debt markets are, and it's in a kind of constantly evolving, market where certain deals are very attractive to lenders, and other ones maybe less so. Part of what we've seen and what we were hearing about is in order to get a deal done, you have to be willing to really inject a lot more equity than you'd be used to, and with probably a goal of taking on debt at a later stage, right? So I think, for instance, we've looked at a deal where it's a very competitive process, and we really liked the company, so we went in from a full equity position, a zero leverage, just because we wanted to show that we were ready to go and be very competitive in that process. So I think I've heard more and more of that happening, and private equity firms are willing to take that on just because they know at some point the banks will come back and they'll be able to put the leverage on that they think is appropriate for that type of company. So I would say certainty close is extremely important from that respect, is having the willingness to do that, and not being contingent on some kind of financing. I think that gets you definitely a leg up on your competition and allows you to get into processes that probably you wouldn't otherwise be in.
Aziz, would love to hear your thoughts on that, Aziz.
Yeah, I think, look, I'm going to, be fairly consistent with what Sean has said. Obviously, deal certainty matters the most for us, especially in this environment, or not the most, but is a key factor for us. And we actually are involved in a few situations where some institutions put forward, some LOIs or some offer letters with no financing contingency, and effectively they were all equitizing the investment upfront. So obviously, we do, like these because there's a bit less of a dependency on the financing partners.
Got it. Thank you. There's another question here that talks about just how important are the earnouts for equity deals to bridge the valuation gap due to COVID between buyers and sellers? And up to what % of the financing do you see that happening for?
I'll maybe start on that one. Look, we're only in month 6 here of COVID, and a lot of transactions were delayed. So it's hard at this stage to put hard and fast rules in terms of percentages or give specifics on numbers. But we are seeing creative ways, to answer the first part of the question around how to bridge the gap, the bid-ask spread, which is obviously, in some cases happening. We are seeing earnouts, but we're also seeing investors coming forward with more structured investments. So think of, a portion of the capital is coming out of the form of common equity, say pari passu with the selling shareholders or the management team, and then another portion coming under the form of a convertible pref, which kind of gives them downside protection. So we're seeing some creativity around the table to help bridge that gap. But I'd say it's too early to put hard and fast rules, given where we are in the cycle, not the cycle, but in COVID.
Okay, Sean, go ahead.
Yeah, so earnout for a lot of entrepreneurs or PE owners seems to be like a very bad word, but it seems to evolve into contingent consideration is the more fancy way of saying it. But I think in the end, it's just you want to pay a value for a pre-COVID multiple on a company that's suffered as a result of COVID. That's a very effective way of doing it. And so you want to flash that valuation and say, listen, we really understand that your company is doing well and was doing very well before COVID, and it warrants a very high multiple. But we're going to need some certainty around that, and you put it, can you build out the upside in terms of in kind of an earn-out kind of fashion. So I'd say we're seeing that a lot more. I've heard that it's being used quite a lot more in terms of across processes in my various discussions with the intermediaries out there. So I say it's becoming more and more prevalent. I don't know what percentage of deals are getting done that way. I think if you want to really be aggressive and get a deal done, then you obviously don't include it. But ultimately, I think there's still a lot of uncertainty out there, so they're becoming a bit more frequent in terms of certain types of deals.
Got it. Thank you. We have one last question here. How are you folks using analytics in the process of deal making? So maybe we can start with Aziz and then end with Sean.
Yeah, it's a very good question. Look, fundamentally, one of the reasons, and it's going to be music to your ears, Amit, one of the reasons we're bringing DealCloud in is a lot of the analytics in terms of managing our buyer logs and understanding and analyzing investor behavior and processes is currently very difficult and requires a highly manual process. So while we do manage on separate spreadsheets, how many deals do we bring to close versus, how many sell sides we have, where do the values transact versus, where does the company transact versus the values that we pitch? These things are being tracked really on a manual basis. And the intention is with DealCloud, as far as deal making is concerned, is that we're going to move towards a central repository that's going to help this become automated, but most importantly, understand things like, how does Novacap behave on a process? Are they typically holding value, or are they, typically retrading down the line? Are they, and so on. And unfortunately, as of today, we kind of know it. We have a good sense just given we know our clients, but obviously DealCloud will help us have real facts about this.
I can promise you that question was not planted by me.
Yeah. So I guess, just to add on to what Aziz was saying, buyer behavior is a very important aspect for what we look at internally. We want to make sure that we understand how we are being perceived by our intermediary partners out there. So we're tracking definitely the analytics aspect of kind of conversion ratios across the board when it comes to, how many NDAs we're signing versus deals seen versus getting to the LOI process to LOI to close and so forth. And we're taking it a step further to understanding, okay, within those categories, like who's showing us the best and high quality deals. So we understand, like, is Aziz showing me 20 deals a year that we don't even sign one NDA on versus like how far in the process are we getting with the deals that Aziz is showing us, are we, are we compatible with the types of deals that, Aziz and National Bank are showing us? So we're really trying to delve deep into the types of I guess, analytics we can gain by the information that we're gathering. And, that's a process that we started probably just under 2 years ago. And it's a process that we're really spending a lot more time on moving forward, because ultimately we want to know, we want to know every angle, whether it's from a relationship standpoint, just, who's worth spending time on based on the numbers, other than kind of what we feel, from the types of deals that we're seeing, how far are we getting, also from internally, like how are we being perceived externally? Are we being seen as a low value type of shop? Are we seen in the middle, and so forth? So we really need to understand internally, all this type of information. And I would say that the analytics aspect of it has become increasingly more important for us, and we're placing a lot more emphasis around it at Novacap.
Awesome, Shan, that was very insightful. Thank you, Aziz. With that, we've come to the end of our webinar, and I want to take the opportunity to thank Sean and Aziz for spending your time with us, sharing your thoughts and answering some of these questions. I'm sure the audience appreciates all the experiences and nuggets that you guys are sharing here today. Just for the audience as well, I'd love to just thank you for joining us today. And as a reminder, this webinar was recorded and will be made available to you shortly. Also, as Kim said earlier, this is the first in a series of a number of different webinars that we will run through the Invest Canada webinar series. So stay tuned for more details. Also, there's multiple webinars that DealCloud has ran and will continue to run, so you can find details on our website. And then if there's any questions that anybody has from the audience, there is an email address that you can see on your screen. Please feel free to reach out to us and we'll try our best. With that, I'd like to thank everybody once again. Sean, Aziz, much appreciated. Everybody in the audience, thank you so much for your time and have a great day.